Hello, and welcome to another Dolphin Financial Radio. We're going to be talking about investing in a decreasing rate environment. Yes, how do you invest when rates are going down? Let me bring in my co-host, Tony Shore, to help me talk about this. Welcome to the show, Tony. Yeah, what have we been experiencing? We're at the end of 2023. It's been a year of decreasing rates, would you say? Or
No. What are you talking about? The rates have been going up and up and up.
Right. They have. You're right. But knowing that at some point this climb is going to stop, and the Federal Reserve has announced that they're planning to decrease rates in 2024, I'd like to get ahead of the game and say, well, what do we do? How do we invest in a market that the rates go down? Because we were just dealing with the rates going up, and investing in that market was difficult. Let's talk about whether it's easier to invest when rates are going down. I don't know. What do you think? It reminds me of The Price is Right. Remember the Bob Barker and that yodeler? Like that. I wish I had a video of that. The yodeler going up the mountain, and you had to try and hope that he doesn't fall off the cliff. I think we're kind of at that point now where people are saying, well, are we at the top here? Are we at the top? So I'm going to give some tips on where I would be looking right now at the end of 2023 and in the early 2024.
Stop. The Price is Right reference.
You don't like it?
Hilarious.
You know what I'm talking about, right?
It just hit me. That's why it took me a minute. I'm like, what is he? And I'm like, oh yeah, the little guy that. Oh my gosh.
We aged ourselves because I don't think.
We did
since in over this century. I don't think. Look it up if you're wondering what that is. But I think most of my listeners are aware of The Price is Right. Yodeler guy.
I'm sure. Yeah.
Okay, so I will say this. I'm going to give some ideas for how to start the 2024 off with investing, what to think about. But I don't know anything. Just remember that. For every time I say this is the hot trend. Anytime I can find a video clip of an expert saying now's the time to buy gold, then I can find a clip right the same day of someone saying gold is the worst thing to buy, right? So just know that as a caveat. But let's talk about what kind of conversations I've been having with my clientele who are looking at retirement investing, generally speaking. The first thing we're going to look at is locking in these fixed rates. Now, 2 years ago, Tony, we did shows on different rates and CD rates, and we were like, oh, you can get 2% at a regional bank,
Wow.
And then they just kept going up and up, and we've done shows on fixed rates. And the question becomes, well, if the Fed lowers rates and the banks start lowering the CD rates and treasuries are going down, which they have been at the end of 2023, these multi-year guarantee annuities or MYGAs, are they peaked? Are they at the top? And do I want to lock in for an extended time now while the getting is good?
A lot of people would say they have peaked.
Right. And I've seen it. I've seen companies lowering rates at the end of 2023. And so the question is, are they going to be lowering for good, or are they going to come back up? I don't know. I don't. No one knows. Anyone that tells you they know is, lying to themselves. I think, though, that the idea of locking in, say, a 10-year fixed rate of, say, 6%, and I'm not saying, you watching this now, that may not be available, but let's just say it is. Would you lock that in? Would now be a time to do that? Would now be the time to lock in a long-term CD that's paying a high rate? This is something to think about when you're in a decreasing rate environment. It actually may make sense. Of course, you don't want to put all your eggs in one basket, and you got to be careful with where you're putting your money and which banks and which insurance companies and such. But a 10-year at 6% sounds appealing. in an interest rate environment that goes down. Now, as it was going up, and you could lock in 10 years at 4%, you would be kicking yourself because you could got 4.5 and 5 and
Right.
6 and so on.
Right.
But at some point, you have to just put a line in the sand and say, I'm comfortable with that rate for 5 years, 10 years, 3 years, 6 years, whatever the choice is, whatever your time horizon is. Obviously, a lot more goes into it than just a random number. But this might be the time to do that. And what prevents people from doing that is the unknown. Oh, well, if I lock in now, what if they raise rates again? What if we have inflation again and I can get an 8% CD? There's a risk. There's a risk you got to take. But by locking in a longer term rate, you're eliminating a type of risk called reinvestment risk, which is when that 1-year CD comes due in a year, you're going to have to do something with the money. And if rates are down, what then? You would have said, man, I wish I could go out 2 years or 3 years with this rate. So that would be the first and most obvious thing that I would be telling people to look at when we start facing rates that are going down.
So what's the answer to that? Don't do a CD then if it's shorter term, because the rates will probably be going down. Use something that you can do, lock in a rate longer term, like a MYGA. Is that what you're saying?
Right. Typically, the longer you go out, the higher the rates.
Right.
So, and that happened for the most part, but then in 2023, CD rates were kind of flipping. So the shorter you go, and that's just because the banks are looking ahead saying, oh, rates are going to be lower. I don't want to lock in. They don't want to lock in to a bad deal for themselves.
Right.
So insurance companies have a little bit more time horizon leniency. And so, but even those are going down. So yeah, the answer is not necessarily to lock in a long-term rate, but it is to consider it for a portion. If you have a emergency fund, not emergency fund. If you have a bucket of money that you say, I'm not going to need this for 5 years, maybe you lock it up for 5 years. As long as you got an emergency fund elsewhere, liquidity elsewhere. That's the downside to these is, if I buy a long-term treasury, I'm locked in for so long, I don't want to have to sell it and lose or, risk any fees if I buy an annuity. I don't want to forego my interest if I buy a long-term CD and I have to change. So you have to be thoughtful about it. But yeah, I think the answer is pick a portion that you're comfortable with and see if you can lock it up for a time that you're comfortable with. I don't see anything wrong with that, especially in a decreasing rate environment.
Okay. Yeah, that makes perfect sense. And obviously, the reason we're talking about this is because the Fed has hinted at the fact that not only are they not going to raise rates next year, they're looking to possibly lower them.
Right. And the whole point of them raising rates was to stem the inflation. And by many of the metrics, inflation has come down. Now, it's still going up. So it's not like, oh, inflation's gone down. That means we're going to pay less than we did yesterday for the products. No, it just means that instead of it going up 10%, 12%, or whatever it was, it's gone up 3%. And they're trying to get to 2. But 4 is better than 8 when it comes to inflation, and 2 is ideal, right?
Right.
So they raise rates to slow everyone down, to say, hold on, let's calm down the frothiness, and then everything slows down and prices come down and things stabilize. Are they going to just slash rates in half? No, they probably will go down gradually, just as they did going up. Although they went up pretty darn quick, I would say.
Yeah, they did.
Nothing saying that they can't go down that quick. Okay, another place to look, if you're saying, okay, I get that fixed rate, that's great, but what else? What else could I be looking at? I would look at long-term growth in either stocks or real estate or some combo. You can buy a REIT or you can buy some housing stocks. And why? Why am I looking long-term? Well, first, you always want to go look long-term with stocks. If you want to try and pick stocks for short-term, day trading, swing trading, whatever you call it, that's a fool's errand. I've been down that path, literally. I was a trader for quite a number of years. It's difficult, and especially when you're getting close to retirement, you're dealing with your own money. It's like, yeah, I don't know if I need that risk. But if you have a long-term horizon, stocks are still the place to be. And if you look at the housing, what happened there, they got hurt because interest rates went up and less people can borrow. And so everything slowed down. But maybe those home builders or whatever will pick up. So you look at it in terms of long-term trends, and that's what I think you'll see in a decreasing rate environment. You might see the stocks that didn't do so well, maybe dividend payers stocks that didn't do as well as the growth stocks. If you think about what the stock market did in 2023, you had basically, they call them the Magnificent Seven, these seven big names, Apple and Microsoft and so forth. They're the ones driving all this growth, right? So maybe you take some of the gains there, or you don't jump on those because they're high, and you go for the names that you've known in the past, but that didn't have the huge gains of 23. Maybe those will be the ones, the smaller companies.
Yeah, you mentioned the Magnificent Seven, and it is fascinating to me that the S&P 500, the 500 means there's 500 different companies in there, 500 different stocks.
Right.
And it just came out that, especially in the past year, but even a little longer, 7 companies make up the majority of the growth. The growth for 2023, I think, in the S&P was around 24-25%. And the 7 companies made up almost all of that.
Right.
Only 3% of that. Only 3% of that growth was the remaining 493. Right?
Exactly. So there's 400 other stocks out there that are potentially poised for a rebound.
Yeah.
Or some growth. So don't always rely on those 7. I tell people, oh, you get an S&P 500, it's doing so well. It's really 7 stocks that are driving it. You're right.
Yeah.
What about all the rest? Well, you can invest in all the rest. I mean, I'm not telling people stop being stock pickers, but you can go in and grow like a value or a dividend portfolio, something like that. So that's something I would look at in a decreasing rate environment.
Right.
Another more nebulous or more personal decision would be about your housing situation. A lot of people, and especially for retirees, they bought a house and it's gone up crazy. The housing market was immensely huge in terms of growth in 21, 22, 23. And so now's the time to say, well, do I need this much house? Can I sell it now and get this value? Because a lot of that value is just locked up in the house through equity. The only way to get that is to borrow from it, which I'm not suggesting to do. But maybe it's time to look at, well, do I need this big house anymore? Is now the time to downsize to match my retirement lifestyle? And then I use the equity that I've gained in that to invest in other ways or live off of or change my lifestyle. Now, many will say, well, even the smaller houses I want are now up in price. True, but they're probably not as high as the larger house that you have. Or even if it's just we're going to reduce the size of our house, and we're not going to have any equity gains. It's going to be the same as selling our house, and we're going to buy a new house that's smaller but just as expensive. You're saving in other ways. You're saving potentially on taxes. You're saving on utilities. You're saving on travel, location, and you're better spot oriented for the future going forward. Why not kind of lock in those gains on your house now? Because if you want to do that in the future and your house value goes down, well, you say, well, the other house I'm buying value went down. So again, I'm not trying to time the market. I'm just saying now's a good time to do that in a decreasing interest rate environment, because as rates go down, housing prices might stabilize or start to go up again. So, there's never a good time for these types of things. It's usually you do it too late, right? So I'm saying be proactive about it.
Yeah,
This might be the time to do it. And who knows? And again, we did a show on taking a mortgage in retirement and how that's not the end of the world. That might be something to consider. And maybe as rates come down, mortgages will be more reasonable and you could do that.
Sure.
But here's the biggie, Tony. Let's look at bonds. Remember what bonds were supposed to do? You buy stocks and you buy bonds. And as you get older, you get more bonds and less stocks, right? And the stocks go up, the bonds kind of are flat. Stocks go down, bonds go up, right? That didn't happen in 2022. It was the worst year for bonds that I know of. Why is that? Well, interest rates were going up. So when that bond you had that was paying 2%, 3%, and everyone else said, hey, I can get a new bond paying 5%, 6%. Why would I buy yours? In fact, I'll sell yours. And so will everyone else. And so the bond prices went down.
Yeah.
Now we're at a point where the reverse is going to happen, theoretically. Interest rates go down, theoretically, bond prices can go up because the bonds that you buy today are paying higher rates that they won't offer those in the future. So this might be a time to start looking at bonds. We did a show in the past about how bonds may not be the best thing, and turned out to be correct about that. Again, blind squirrel gets a nut every once in a while, right, Tony? But the theory was,
Nobody has a
bonds aren't
crystal
the
ball,
be-all,
Dan.
end-all. No one does. But the bonds aren't the be-all, end-all that some people tout them to be. But maybe now's the time to look at them as an option, and you can buy these long term. You can hold them to maturity and actually know what you're going to get. Again, it's just like the fixed rates in the beginning. Now's the time to look at maybe locking in those good returns.
Yeah. I think
Did you ever think I was going to mention bonds? Did you ever think I was going to go on the bond bandwagon?
No, but you were right about bonds weren't a great idea, and they really tanked in 2022.
Yeah, in 2022.
Yeah.
Right. I like using CDs, treasuries, fixed annuities as a bond alternative.
Yeah.
Less risk of price fluctuations. There's drawbacks to it, but why not just get a fixed rate and without the price changes? You give up liquidity. It's so. But I'm not against any type of vehicle. I'm not against anything. I'll use whatever makes the most sense. So I don't have an agenda of, I'm a bond guy or I'm a bond hater.
But it depends on the
those people.
person's individual situation, right?
Right.
And
Right.
I mean, basically, it depends on if somebody might be better suited for bonds, and somebody might be better suited for a MIGA, right?
Right. But don't vilify one or the other.
No.
Those people. You could pull those people off the street. You see them walking. Oh, that guy hates bonds. I could just tell by the look on him.
Yeah.
Okay. So conclusion: as rates are coming down, you have to adjust. Just like you were supposed to be adjusting as rates are going up. You can't just buy and hold or have the same set plan, especially as you get nearer retirement. You have to look and see what is going on. If we know that I'm going to retire in 2024, then you need to make sure you have some cash ready to go to pay for that. You don't want to be stuck at the whims of the market. What if we have a crash? What if we have go up and you put all your money in cash? Like you don't try and time it. Time your retirement based on your goals. Have a plan. And as we see interest rates coming down, make sure that your plan is adjusting for that. Don't just, I saw people get hurt so badly because they're like, oh, bonds are the way to go. And in 2022, they lost 30, 40%. And it's like, well, how did that happen? I thought, it happens. It happens because you're just burying your head in the sand and you're forgetting what the point is. You have to be nimble, but don't chase. There's a difference between being nimble and chasing return and going with whatever direction wind's blowing, jumping in that. That's not what I'm saying.
And because by the time you feel that wind, it's probably getting ready to change. By the time you hear about something or, wow, that's huge, it's usually too late at that point.
Right. Yeah. And I might remind our listeners to go back and watch the show on Bitcoin that Tony said it's a scam, a fad.
Well,
all right.
Was
Tony.
I wrong?
To be determined.
Yeah, to be determined.
Good show.
It has been so far.
Think about what's happening in the interest rate environment. Maybe fast forward to the end of 2024, we'll be having a conversation about, wow, I didn't think they were going to lower rates that quick. I didn't know, it's going to be an interesting one.
But Dan, I think the key lesson here, though, is everything you've told us so far in the show. Before we go, I want to note that the key is really working with a financial professional who's a fiduciary, who's independent, who's going to look out for your best interests and look at the big picture and look at all the options. So I encourage our listeners and viewers out there to get a hold of you.
Yeah, your plan isn't as important as the process. So going through the process and having someone help you through it is much more useful than just having a plan. So it's important to go through that process, and it's better if you have someone that knows what they're doing helping you through it. But in the least, think about it. Don't just, bury your head in the sand. So, Tony, thanks for a good show. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.